Hey, everybody. We need to talk about the AI infrastructure race. We now have the earnings results for Q1 2026 for Amazon, Microsoft, Alphabet, and Meta. We don't have Oracle yet, but they're quite a bit smaller. So let's start with the big four. We need to talk about this CapEx race, acknowledge the fact that return on investment is most certainly there for these big spending budgets, and then finish this off with a bit of discussion on what's in store, what we think should be in store for the neocloud companies and the enterprise software companies. First thing, I just want to review here really quick. There's reactions in the stock price immediately following earnings, and there is no doubt some confusion lingering as to why some of the hyperscalers are going up after reporting Q1 2026, like Amazon and Alphabet, and why some are going down. Meta, Microsoft, when it reported last week, reaction was just pretty lackluster. It's not about a company beating or missing current quarter earnings. It's about especially the immediate term outlook and changes in that outlook and how those changes will affect especially the next couple of years of profitability. If the cash flow profit growth expectation goes up more than expected, the stocks tend to go up. And conversely, if the cash flow growth expectation for the immediate term goes down, the stock price goes down. Really just need to get over the fact that this has less to do with the company beating or missing earnings and has more to do with cash flow expectations, especially in the next couple of years. Or better yet, you can just digest all of the earnings information and kind of just ignore the short-term moves in the stock price. Law of small numbers. These things get smoothed out, sometimes even as early as just a few days or a week or two after the earnings report. So what exactly is happening here? Just a quick recap. AI data centers, hyperscaler CapEx investments, cloud computing infrastructure, all of this is really a form of, you can think of it as 21st century utility services. For a lot of companies, investing in all of the computing resources that they need to get their job done probably just doesn't make sense. And so instead, maybe you go out and you rent the computing you need from one of the hyperscalers. This has been the norm now for a decade and a half, 2 decades, lots of investment pouring into this, a lot of companies utilizing this business model, and controlling this infrastructure layer has made these hyperscaler companies incredibly powerful. And remember, they're vertically integrated. They all have some form of end market product or service that they sell, in addition to renting out compute to other companies, many of which their cloud infrastructure and AI infrastructure companies compete with the end market product that they are building themselves, that Amazon, Alphabet, Microsoft, Meta, and even Oracle offer their customers. At any rate, let's move on to the CapEx like we have for a couple of years now and just look at the guidance. These numbers are still really crazy to look at and try to wrap our heads around, but here's Microsoft, about $31 billion in CapEx in Q1 2026. Amazon, remember, it's not just AWS, it's primarily AWS that's gobbling up this $44 billion in CapEx, but they also have the e-commerce fulfillment centers and so on that also eats up some of that CapEx, but most of it AWS. Alphabet, Google, kind of a similar deal. Yes, it's Google Cloud, but also Alphabet has Google Search and they need data centers to support Google Search and Google Ads, but Google Cloud, as we'll see here in just a moment, definitely moving the needle. And then Meta, not technically a cloud infrastructure provider. Actually, there's nothing technical about that at all. They're not a cloud infrastructure provider, but they do provide services to marketers and the companies that those marketers represent and monetize that through a massive user base, well over 3 billion users around the world across Facebook, Instagram, and WhatsApp. 18 billion in CapEx this quarter, down a bit sequentially, but the CapEx guidance, especially at Alphabet and Meta last night, the CapEx guidance for 2026 was increased significantly by about $10 billion compared to what the previous guidance was. Collectively, $130 billion in CapEx spent in the first quarter of 2026 by Amazon, Microsoft, Alphabet, and Meta. These quarterly CapEx figures are going to accelerate That is still the expectation as the year continues, especially the second half of 2026. Amazon still sitting at about $200 billion in expected CapEx. Microsoft, $190 billion. Alphabet raised their guidance a bit, now $180 to $190 billion in expected CapEx, and likewise Meta increased theirs as well to a range of $125 to $145 billion in expected CapEx for the year. In total, about $710 billion in expected CapEx. If you add in Oracle's expected CapEx, we are now sitting at well over $750 billion in expected capital expenditures for the full year 2026 period. Almost 70% increase roughly from 2025 spending. We are very much in the midst of a CapEx growth cycle that will have to moderate, at least as a percentage of revenue will have to moderate. And this is, of course, flowing to the semiconductor companies. Accelerated computing and AI infrastructure led by companies like Nvidia, Broadcom, AMD, and the list goes on and on. That growth that they are reporting will continue to reaccelerate throughout this year. And we expect the growth rate will moderate in 2027, but the growth rate, at least as far as the data is being read right now and indicated right now, the growth momentum will at least carry over into 2027, although the actual growth rate itself will slow. But as it stands right now, there is the end market cycle chart. Breaking this down a little bit more specifically across the hyperscalers, let's talk about their return on invested capital. It makes the free cash flow numbers really wonky. Just last quarter, we had the update talking about the revenue to CapEx ratios really just completely out of whack. That is why this CapEx spending will have to moderate as early as 2027. But you can see the ROI already showing up. And the easiest way you can do this is just looking at possible revenue acceleration in tandem with operating profit margin going up. And we use operating profit margin, not free cash flow margin, certainly not net income margin, because some of these companies, especially notably Alphabet, which we'll look at on the next slide, there are effects of the companies making non-operating investments, for example, like Alphabet investing in SpaceX. That's the best way to just very simply measure the early ROI from these CapEx spending. So we'll start with Amazon, 16.6% year-over-year revenue growth in Q1, 28% for AWS specifically. Total revenue, $182 billion, $37.6 billion of that is AWS. Operating margin for the business overall was 13.1% versus 11.8% in Q1 2025 and 10.7% in Q1 2024. Continued margin expansion, that's great for Amazon. Microsoft, 18.3% year-over-year revenue growth in Q1 2026, 29% year-over-year for Intelligent Cloud, that is Microsoft Azure and what they used to report separately, Azure and Intelligent Cloud. Let's just lump it all together. Intelligent Cloud, total revenue, $83 billion, $34.7 billion of that, the Intelligent Cloud segment. So of all these companies, Microsoft now has the highest percentage of its overall revenue being Intelligent Cloud and AI, cloud infrastructure and AI infrastructure. Operating margin for the business overall, 46.3% in Q1 2026 compared to 45.7% in Q1 2025 and 44.6% in Q1 2024. So nice operating margin increases there. Moving to Alphabet, 21.8% year-over-year revenue growth in Q1, 63% year-over-year growth for Google Cloud. Total revenue, $110 billion, $20 billion of that from Google Cloud in the last quarter. Total operating profit margin, 36.1%, which is pretty incredible. It was 33.9% in 2025 and 31.6% in Q1 2024. Huge operating margin increases, especially as Google Cloud has grown so much the last couple of years and its operating margins have flipped from negative to positive. That was called out, especially a couple of years ago when that event happened. And that trend just keeps on going. Great stuff here for Alphabet shareholders. Now the one that maybe didn't have such a great reaction last night in earnings, and you're going to see immediately why, based off of the first slide I showed you and the little intro here for Meta, 33% year-over-year revenue growth. to 56 billion. That's not the problem here. Revenue continues to accelerate. That's fantastic. But the CapEx guidance did increase significantly. More than half of the revenue is getting spent this year in CapEx. At least that's the expectation. So even more CapEx spending had to be accounted for in the stock price. And also, you note here the operating margin, 40.6% in Q1 compared to 41.5% in Q1 2025. So a little bit of a dip in the operating margin, and that is because of the higher depreciation expense of the CapEx Meta has been spending as of late. Overall, though, still things trending in the right direction, 37.9% in Q1 2024. Still good for Meta, but a little bit extra volatility because of the higher rate of CapEx spend, kind of similar to what we're seeing with Oracle as well. In total, these businesses continue to just put up incredible revenue growth, incredible profitability growth, arguably some of the best businesses ever devised in human history. And the pace of growth and profitability for shareholders is certainly not slowing down, at least not this year. Which leads us to part 2 of this discussion. What does this mean for the neoclouds and the enterprise software companies? Because these are the companies that are under attack, under pressure. Obviously, the neocloud stock price is performing just fine as of late. Enterprise software certainly not performing just fine because the hyperscalers and their AI lab investments, like OpenAI and Anthropic, are shifting the landscape. So let's talk about that. Okay. So we've reviewed the CapEx spending for the hyperscalers for Q1 2026, except, of course, Oracle, which will be later on, but we have all the big ones out of the way. And it's very clear now that this CapEx is leading to really excellent return on invested capital, ROIC. That was the big concern over the last couple of years. The mainstream criticism among investors on Wall Street was, where's the end market application? Where's the use? Where's the AI actually happening? Quick rehash on this for those of you that have been with us for the last couple of years. We've talked about this at length, but it needs to be repeated. That initial wave of CapEx that happened immediately after the ChatGPT moment in late 2022, and then the corresponding Nvidia moment in early 2023, was the hyperscalers all realizing at the same time that there was massive opportunity here. They started making big investments, but those investments were for themselves. All of the hyperscalers have their own internal workloads and their own products that they sell customers. The benefit of being a vertically integrated technology company like this is when you buy brand new, game-changing technology, you eat first. You eat the best. Who eats second? Your strategic partners, especially those that you invest in. In this case, those happen to be potential future competitors. So OpenAI getting the big investment from first Microsoft and then others later on. Amazon investing in Anthropic and so on and so forth. That's who eats second once this big game-changing technology has been identified, or in this case, helped prove the benefits of this new technology. And then who eats third? All the other customers that rent the infrastructure because they're not vertically integrated. Enterprise software, thus SaaS apocalypse, and all these enterprise software companies scrambling to make these investments now and get caught up to basically where the puck already went. They're not skating to where the puck is going to be, they're chasing the puck. So that's what's happened. This is why there's fantastic ROI happening for the hyperscalers. They bought that initial wave of CapEx first. It was all internal workloads, which is why you didn't see this massive flood of end market AI immediately. They used the accelerated computing hardware to improve their own internal workloads, improve their profitability, right-size their headcount in the wake of the pandemic. And now you're starting to see that trickle out into the market. A bunch of new AI products, AI software, and the enterprise guys trying to catch up. Okay, but this is all well known at this point. Everybody knows about the hyperscaler CapEx and which metric to watch. But let's build on some more what we've talked about now regarding the neoclouds and the conundrum therein, and also the enterprise SaaS companies and the other legacy software companies that are between a rock and a hard place. If you're one of these companies, if you're in one of these two camps, Neo Cloud, you have lots of great infrastructure, but you have no vertical integration because you have very little, if any, actual final product. Infrastructure is not a final product. And so the economics of that long term are very difficult. The moment this infrastructure capacity eases up a little bit, there's a little bit of spare demand left over, the economics start to break down real quick for the neoclouds. Conversely, the enterprise software companies, the disadvantage they're in, most of them have very little to no infrastructure. And so they get stuck with the leftovers after everybody else has eaten first. This is why they're playing catch up right now. And so they're not vertically integrated because they don't have that infrastructure underlying their end market product, which puts you at a disadvantage if you're in a race, if you're trying to keep pace with innovation at the hyperscalers and the AI labs that have lots of funding. This is one of the strategies we would expect to see in the coming years. If you're a neocloud, the moment you get any hint whatsoever of there being excess capacity in your network of data centers and your GPU-based servers, acquiring more infrastructure is not the answer. You need to start to vertically integrate if long-term you want to survive and continue to compete against the vertically integrated hyperscalers. Or conversely, what could happen if you're an enterprise SaaS company or a software company, you have great products, but suddenly those products are at risk because the underlying infrastructure technology has shifted out from under you. You need to gain some control over your infrastructure. You also need to vertically integrate. And we've seen hints of this happen. We've seen companies like Salesforce acquire an infrastructure software company like Informatica. We've even seen some of these enterprise SaaS companies, enterprise software, start to build some of their own data center infrastructure like Snowflake or Fortinet, or even the Trade Desk has been making some CapEx investments. But if they see opportunity to do so, we would expect leading software companies to also do the same. Maybe they start acquiring some of these distressed neocloud assets and start to build some vertical integration. This is what is needed if you are going to continue to compete long-term. This is not as simple as just continuing to grow revenue and scale towards profitability. These are very, very basic financial metrics. It's too easy. Accelerating your revenue because the AI labs and the hyperscalers are accelerating their revenue. It's too easy. It's not that simple. To play the long game, this is what needs to happen. Top neoclouds need to start developing software and services of their own to help fill up any spare capacity that they may suspect in their network. And enterprise software companies need to start figuring out how to scoop up infrastructure assets so that they can continue playing this game and not get left behind and get stuck in this endless doom loop of forever needing to dump R&D dollars into your products and really ultimately ending up with the best infrastructure technology only after everybody else has had it first.